When you look at U.S. equities, they just kept climbing through the day. They closed at their session highs. Volume was also higher than what we had seen the last 20 days. In the case of the Dow, we're looking at volume that's 12%, 13% above the 20-day average. Everyone's buying in.
Yeah, I think so far the early story of 2018 is just so much enthusiasm about financial assets. And where you see that kind of manifest and playing out around the world is relative strength indicators. So they kind of judge both the persistence, the speed and the magnitude of recent market moves. Basically all over the world, what this chart is showing you is the 14-day relative strength index. And for everywhere except Europe, the Euro Stoxx 600, it's signaling that it's an overbought territory. So that's just really a testament to the speed and the magnitude of the moves just as we break into the year.
Right. Europe is the line at the bottom here, the purple line, and it's below that 70 relative strength index level. But the momentum is to the upside.
Yes, generally. And there's a lot of reason to believe that all of this enthusiasm is grounded in something real. When we look at a report from Bank of America earlier this week, they're talking about the earnings revision ratio for S&P 500 companies skyrocketing, and what's even more, the sales revision ratio skyrocketing by even more. So it speaks to the strength of the global economy that's expected to continue. That's been affirmed by PMI data, by commodities roaring, and that's the financial asset enthusiasm. So far, that's the early winner of 2018.
You also break it down in terms of different asset classes as well. I've got a chart here that you call a curious cocktail, looking at retail stocks and oil. Talk us through this one.
Yeah, so I mean, when you think about it rationally, as we saw earlier this week with, say, we're spending more on heating oil and natural gas than anything else, burning a record amount of that as this snow bomb hits. Generally you would expect that to, in future months, probably take something out of domestic discretionary retail consumption. However, the markets are saying they're not kind of worried about elements like that. Crude oil and retail stocks, the relative performance relative to the S&P 500, generally you see them move in an inverse direction. Right now, retail's outperforming, and oil, besides today, continues to march higher. So that shows amid this enthusiasm, there's still some dichotomies that maybe won't persist for that much longer.
Can't we just argue that retail stocks have been so beaten up, actually, that a bit of bounce, dead cat bounce, maybe?
More than a dead cat.
Yes.
More than that, for a while we've seen in XRT, which is an equal weight retail ETF, we've seen short interest in that absolutely plummet in recent months. So there's obviously an element of short covering of recovery to this, and we did just have this record holiday season, but even so, L Brands, JCPenney, Macy's showing it didn't lift all boats as much as expected.
Okay, the theoretical fly in the ointment that people would point to is what we're seeing in the rates market, every day, that flattening. You have a chart here, though, that you call not a bearish story, and it looks at a few different spreads. So tell me what we're looking at here and why it's not bearish.
So I think this week was probably one of the best times we've had to show why flattening isn't necessarily bearish. What we're showing here is the lines of the candle lines that's just the 2s, 10s curve, and we saw yesterday it breached 50 basis points for the first time in forever. But what's happening amid this? The real curve, so that's derived from tips, the real curve 2s, 10s is actually steepening. In other words, we're kind of getting more confident that we'll get back to that neutral that the Fed thinks is neutral, something that the market's always pushed back against for years and years and years. At the same time, because of this commodities rally, we've seen nearer term inflation break-evens rise by more than their longer dated peers. So put this together, as much as you can infer real things from inflation break-evens, the market's saying the Fed's going to be at its target sooner, and its long-term plan looks better than it did 2 weeks ago. Why is that bad?